Good afternoon, friend. Is it afternoon? Yes. Good afternoon, friends and fellow associates. I hope you are all having a lovely day. Today, we will be going over a quick presentation that I made, essentially highlighting my thesis and my case for investing in international equities moving into 2026. Short, brief, yet informative. Let's have a little bit of coffee to start off. It's cold. My coffee's cold. That is quite disappointing. Beautiful. Can everybody see that? Who am I even talking to? I'm just recording this in my house by myself. Okay, so why am I making the case for global equities moving into 2026? Well, after 10 years of US market dominance, things are starting to change coming out of 2025. International stocks have beat the S&P 500 by almost 15 percentage points, essentially signaling what I believe to be a new trend in global investing. Now, this change is driven by three catalysts, primarily valuation gaps, currency changes, and similar earnings growth worldwide. Okay, now what we have here is the historic shift in market leadership coming out of 2025. Down all the way over here is my buddy S&P 500, looking at 17.9% total return in 2025. We have the Japan index at about 27.2%. The MSCI, which is the international index for mid and large cap stocks, excluding the USA, which is at 32.4%. We have the Spain index, which is at 52%, and the South Korea at a whopping 76% total return in 2025. These are very substantial margins, people. Now, why are we seeing this performance dispersion across global markets? I'm glad you asked. These are the three main trends I believe are going to support investment in non-US assets moving into 2026. First and foremost, extreme valuation disparity. Valuation gaps are extremely wide right now. By the end of 2025, the S&P 500 traded at 21.9 times forward earnings, while the MSCI ACWI, which again is the All Country World Index, excluding the United States, was trading at 13.9 times forward earnings. This big gap, essentially this big discount, provides investors with greater safety margins and a better chance that prices will eventually return to normal, essentially meaning that foreign stocks are at a discount, you could say, at the moment in comparison to US stocks. Trend number two, the currency tailwind. The US dollar dropped nearly 10% in 2025, ending years of dollar dominance that had previously limited international returns. If you were an investor with foreign assets, due to currency exchange rates, whenever you exchange your foreign assets into US dollars, because of the dollar's strength, you evidently lost some of your investment. But due to the dollar's downward trend, I believe this is a much needed incentive to invest more in global stocks. Now, will the dollar continue to depreciate? Well, I guess that's the question. I believe it will, due to three factors. Factor number one, fiscal deficits. Growing US government debt is putting steady downward pressure on the dollar. Due to policies like Trump's big, beautiful bill, government spending is increasing. Reason number two, policy uncertainty. Tariffs and the unpredictable trade actions are eroding investor confidence in the US dollar. Not to mention, as of most recently, Trump's attack on the US Federal Reserve. That is also playing a key role in eroding investor confidence in the US government and the US dollar. Reason number three. Reason number three, monetary convergence. As the Federal Reserve continues to cut rates, the US loses its interest rate edge. So holding dollars becomes less appealing on international markets. Now, will the Federal Reserve continue to cut rates? Some analysts predict that due to the recent jobs report, That is unlikely, but let's not forget Jerome Powell will be stepping down as the Fed chair coming in May, and President Trump's appointee will be stepping in. Now, if I was a betting man, I would bet that Trump's appointee is going to follow along uh, Trump's policies and will more likely than not continue to cut rates. That's just my prediction. Now, the third trend for investing in global stocks is that US companies are not expected to outpace global peers in growth anymore. In 2026, the S&P 500 earnings are forecasted to rise only 13 to 15%, very similar to those of the Eurozone. With growth rates so close, there's really less reason for US stocks to be more expensive and to be trading at the multiples in which they are trading at. There are a few regional catalysts at play that I want to cover. First and foremost, Japan. Japan has, as of recently, begun to overcome its deflation problem. Rising wages are now supporting stock prices, and the new Tokyo Stock Exchange rules are requiring companies to own fewer shares in each other and pay more to shareholders. These changes have led to more share buybacks, which is directly boosting shareholder profits. South Korea, which in 2025 became a leader in the market because of its strong position in AI hardware. Companies like Samsung Electronics and SK Hynix now control over 80% of the high bandwidth memory chip market, which is key for AI data centers. Is there an AI bubble or not? Who am I to say that is not what we're talking about here? Nevertheless, AI investments will continue throughout this year, most likely throughout next year. That's a strong guarantee. On top of that, new government rules to protect smaller investors in Korea have also helped to reduce what was formerly known as the Korea discount. Lastly, European markets, I believe, are giving investors a good mix of financial and industrial stocks. Banks such as Banco Santander, which rose 126% in 2025, have been benefiting from the stable lending conditions in Europe. At the same time, there has been a huge increase in defense spending across Europe, up to 5% of GDP in some countries, such as Germany. The catalyst for this is, again, the rising tensions in the political relationships between the US and our European counterparts. The US, which at one point provided a lot of military defense for the Eurozone, is now essentially backing off. And Trump is telling Europe, hey, man, you guys got to fend for yourself. Because of this, Europe has now needed to arm itself and prepare for any future conflicts, either with Russia and or China. Governments like Germany have already promised millions of dollars in investments into rearming Europe. Okay, so what are some portfolio implications? First and foremost, it is mitigating concentration risk. US markets are heavily concentrated at the top. The five biggest S&P companies make up about 25.7% of the index, while the top five in the ACWI, excluding USA, make up just 7%. Investing internationally helps reduce the risk of depending on a few large US tech firms. Secondly, complementary tech exposure. By investing globally in international tech stocks, you gain access to key semiconductor makers like TSMC and Tokyo Electron, which support major US software firms. This approach gives you a stronger way to invest in the AI trend without concentrating your portfolio in US based stocks. Now, of course, my thesis does not come without risk. First and foremost, the US earnings could surprise everybody to the upside, and capital may eventually rotate back to American growth stocks. It's very plausible. Also, a global geopolitical shock could strengthen the dollar, creating headwinds for foreign assets. And lastly, any escalation in war across Europe or Asia could damage regional sentiment, eventually outweighing some of these fundamental strengths that we discussed. So that was a lot. What is the conclusion here? Essentially, focusing only on US based stocks in your portfolio leaves you as an investor with uneven risk. The large valuation gap, shifting currency trends, and unique growth stories in Japan, Korea, and Europe all support making a change. In 2026, I believe adding more non-US stocks is a smart choice. Now, again, this is not investment advice. I am just a researcher providing research to you, my community. Great. Thanks for tuning in. I will catch you all in the next video.